All right, this is going to be an unscripted guide on what fair value gaps are and everything about fair value gaps in depth. All right, I have not scripted this video. I'm just going to be spitting out everything that I know and everything that is correct, because there is a lot of people who get fair value gaps wrong. So without wasting any more time, let's get started. A fair value gap consists of 3 candles: candle 1, candle 2, and candle 3. The second candle between the higher wick in a bullish scenario, we're talking about a bullish fair value gap at the moment. In a bullish scenario, the high of the first candle, the higher wick, the highest point, and the third candle's lowest point, the wick, the gap between those are called a fair value gap. In this case, this is how you would draw it, from the high here to the low here. I'm going to change the color of this just so you can see it more easily. Right there, that is a fair value gap. Now, what is a fair value gap though? We know that fine, it's made of 3 candles. Fine, it looks like this. What is a fair value gap? What is an imbalance slash fair value gap? Imbalance is just another name. There are also multiple names for this. For example, we have CD and BC, sell side imbalance, buy side imbalance, which just refer to bullish and bearish fair value gaps. It's all the same thing. Same thing. Fair value gap is when price moves too fast and leaves a void behind where there are no trading orders. That is pretty much what it is. This range in here has to be filled. Why? Because price moved so fast that no trading occurred here. No, it's like price. The best way to explain this is, imagine price went from $100. Okay, let me draw this. Imagine price went from, let me draw, from here to here and then to here, right? Imagine this little area in the middle, price never really kind of was within. Price never stood here and let traders trade at that price. So it just explosively moved higher. Price has to come back into this range and give trading opportunities. Okay? That is pretty much what a fair value gap is. There are no trading orders, and the market always goes back to fill in these imbalances. And it's very important for the market to do so. Now we understand what a fair value gap is. And we know it's a void of price orders or trading orders or just trading in general. It's a void. There's nothing in there, and there has to be things put in there. Now we understand that. Now let's talk about IPDA. What is the IPDA? It's the algorithm that runs the markets. If you're an ICT trader, you've obviously heard of the IPDA. You know what the IPDA is. It is clear to you. Now, IPDA says the market has 2 goals. 1, liquidity, right? Essentially, it just wants to manipulate traders. It goes from high to low and 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 high to low. That's essentially the point of IPDA. And 2, fill in inefficiencies. If I can type, I think I wrote that correctly. Fill in inefficiencies, and other words, FVGs. So the market always goes from fair value gaps to external range liquidity, which is highs and lows. It goes from a high to a low. So in a scenario like this, if price is bullish and price then comes back and trades lower into this gap, you would expect it to move higher back above this high right here. That's what it makes sense for it to do. From internal range liquidity to external range liquidity. Now, I just used 2 new words that you probably haven't heard of if you're new to this. IRL, ERL. Internal range liquidity FVGs. Really simple. External range liquidity, highs and lows. Okay? And this is very important for you to understand. And I would say, please take a screenshot of this and understand it, because it's very important. The market runs based off of this pattern from internal to external. Now, Para, why is it named internal range liquidity? It's a fair value gap. Isn't there a imbalance of orders? Then how is there liquidity there? Let's go on any fair value gap for me to demonstrate this. Let's go on the daily, because I think there's a good example of this. Let's mark out any fair value gap. Let's mark this out right here, okay? I'm gonna mark out the low. If it lets me draw, that'd be amazing. There we go. That's the low, and this is the high right there, okay? Let's go on the hourly. There you go. Do you see what I see? This low is the low of the third candle, and this high here is the high of the first candle, and the gap between them is the inefficiency. It's the gap. And what do you see here? Internal range liquidity. A higher time frame fair value gap is always a high or a low on the lower time frame. This is a trick to finding good liquidity as well. This is a trick to finding high probable entries, high probable setups, everything. This right here is internal range liquidity. A FVG on the lower time frame is a high or a low, usually formed, well, not usually formed, always formed by the third candle low high. This is why it's called a internal range liquidity, because it's a low or a high in a bearish scenario. And this is fractal, obviously. It happens all the time, and it happens on every single time frame. For example, if I mark this one out right here, just any fair value gap works. It doesn't have to be a specific one. Let's mark this one out on the 15 minutes. Right there. We can see this was also a high right here. Interesting, no? Interestingly, price goes above this high here and then finds resistance to then continue lower. Very interesting. Now, premium and discount of fair value gaps. Now that we understand the fractality of fair value gaps, and we understand that the third candle always offers liquidity, which is why it's called internal range liquidity, let's understand premium and discount of fair value gaps. Now, what is premium and discount? We obviously, if you're an ICT trader, you should know that. Where did I put my drawings? Right there, right here. But for some reason, they're messed up. Now, a premium and discount of a fair value gap. Let's come here on the other side. And I'm just going to draw a box. Imagine this is a fair value gap, okay? And for you to understand this better, I'm going to draw fair value gap on here. So there you go. First candle high, third candle low. Between them is a fair value gap. Now price has to retrace to fill in this imbalance. You can split fair value gaps into two sides. In a bullish scenario, and this is just reversed for a bearish scenario, but I'll go over the bullish scenario so that it's quicker to explain, and most of you guys like buying anyway. The higher 50%, we have the premium, I would say the discount actually. Discount 50%. Now it doesn't matter what you name these, because you can call both of them premium and it would still make sense. But I would rather call this premium. In a bullish scenario, if we want to see a fair value gap get respected, we do not want to see price violate the lower 50%. Now, a fair value gap can be wicked through. It is one of the only areas that can be wicked through, okay? For example, if an order block gets wicked through, it is no longer valid If you study a little bit of ICD concepts, you know what I mean. A breaker block is not valid if it gets wicked through. Any other PD array, it's not valid, but fair value gaps are different. They are more like a zone than just a PD array. That's just a static PD array. They are more dynamic. Price can wick through them, come back all the way down here, but it's where the body closes that matters. For example, let's imagine a bullish candle and it closes here, and this is what it looks like, and it wicked all the way down here. It has a high, and it has a high as well. Right over here, it has a high. This candle traded all the way down, but where did it close? This close is what matters, where the body is, right? It closed above here. This is a sign that this gap is being held and respected. On the other hand, if this trades into this, closes inside the lower 50%. Now, this is let's turn this into a red candle so it's more clear. Look at this. Price traded all the way back down, pushed above, but closed in the lower 50%. This would make it less probable for the fair value gap to be held. In a bullish scenario, we would just want to see the gap get tapped into in the higher 50% and for price to bounce off of that. Which is why you normally see traders take entries on the high of the fair value gap, but not on the 50%, because it depends on order flow. It depends on order flow. We do not want to see the lower 50% get violated at all. If the lower 50% gets violated, then it is low probable. When a fair value gap gets fully closed through, just like this, it becomes an inversion. What does an inversion mean? It's like we were to displace any other thing. If we have a bullish PD array, for instance, this fair value gap, and we are looking for short confirmations. We close below a bullish fair value gap. That becomes an inversion fair value gap, and now it acts as the opposite of what it was. So if it was a bullish fair value gap and we inversed it, it becomes a bearish inversion gap. And it must be held because price just disrespected it. Price is showing bearish strength. And you can see this in price too, I'm pretty sure. If you just go onto price action, we can see plenty of these. For example, this gap right here. Or even better, the gap right above it. We can see how price was respecting this gap, right? This candle came through, wicked, and closed above. But then the next candle just completely said, nope, I want to disrespect this gap. I want to continue higher. Bam. Closed through. Now this gap must be respected for price to continue bearish. Right here, we can see another gap. Small one, but as they say, it's not the size that matters. The size really doesn't matter. Bearish gap gets respected multiple times. Here, it gets disrespected. Here, it becomes low probable. Completely closed through. And then, now this gap must be held as an inversion and it gets respected. Look at this one here as well. It gets disrespected and then held as support, as resistance to continue pushing price lower. Are there any other examples that I can find? We can maybe draw this one out right here. Oh, let's do this bullish one right here. We can see first price respecting this inversion as bearish, and then we displace it completely. Price comes back into it, finds support on it, continues higher. That's pretty much everything about fair value gaps just covered in this video. I do not like wasting your time. I do not like sugarcoating stuff. This is how fair value gaps work. If someone says otherwise, they're completely wrong. If you were to backtest and if you were to study, you would understand that, yeah, you are right, Para. This is how they fucking run. There's no other way they run. This is how they run. There's only one way, and this is the way. I hope I helped you out. I hope I tell you something. If you want to learn from me, join my Discord. I do have my own mentorship there. Join, check it out. Discord's completely free. The link is in the description. If it's not, it's in my profile bio or in the comments. See you in the next one.